Ever wondered if the money sitting in your M1 Finance account is as safe as the cash in your traditional bank account? It's a question many investors ponder, especially as we navigate an increasingly complex financial landscape. You're probably used to the idea of FDIC insurance protecting your bank deposits, but what about your investments? Do the same rules apply when your money is invested in a diversified portfolio through a platform like M1 Finance? The truth is, the world of investing carries different types of risks than simply holding cash, and understanding these distinctions is absolutely crucial for any informed investor. We're going to dive deep into the fundamental differences in risk between an M1 Finance account and a traditional cash account. This isn't just about technical jargon, it's about empowering you to make smarter decisions with your hard-earned money. We'll break down the types of protection each offers, the inherent risks you face in each scenario, and what you need to consider when allocating your funds. By the end of this video, you'll have a much clearer picture of what safeguards are in place and, more importantly, where your money is truly exposed. Let's start with the familiar, the cash account. When you deposit money into a checking or savings account at a bank, you're primarily relying on a concept known as deposit insurance. In the United States, this is the Federal Deposit Insurance Corporation, or FDIC. The FDIC protects your deposits, up to a certain limit, currently $250,000 per depositor, per insured bank, for each account ownership category. This means that if your bank were to fail, the FDIC would step in and reimburse you for your insured deposits. This is a powerful form of protection that gives most people a sense of security when they see their balance in their bank app. The risk here, from a practical standpoint, is minimal when it comes to the principal amount you've deposited. Your money is not invested in the market, it's held by the bank as a liability. The primary risks associated with a cash account are inflation eroding the purchasing power of your money over time, and perhaps some minor risk if you exceed the FDIC insurance limits at a single institution, though this is rare for most individuals. The key takeaway for cash accounts is that your principal is generally secure against bank failure. Now, let's pivot to M1 Finance. M1 Finance is not a bank in the traditional sense. It's an investment platform, a brokerage. This is a crucial distinction. When you put money into your M1 Finance account, you're not depositing it for safekeeping like in a bank. You're instructing M1 to invest that money on your behalf, according to the pies you've built. These pies consist of various exchange-traded funds, ETFs, and individual stocks. This fundamental difference means the type of protection and the nature of the risks are entirely different. Instead of FDIC insurance, M1 Finance accounts are protected by the Securities Investor Protection Corporation, or SIPC. SIPC protects against the loss of cash and securities, like stocks and ETFs, held by a customer at a failed brokerage firm. Similar to the FDIC, there are limits. SIPC protects up to $500,000 per customer for cash and securities, including a $250,000 limit for cash. It's important to understand what SIPC does and does not protect against. SIPC protects against the failure of the brokerage firm itself, meaning if M1 Finance were to go out of business and be unable to return your securities or cash, SIPC would step in. However, and this is the absolutely critical point, SIPC does not protect against market losses. This is the biggest and most significant risk difference between a cash account and an M1 Finance account. When you invest in stocks or ETFs, the value of those investments can go up or down based on market performance, economic conditions, company news, and a myriad of other factors. If the value of your M1 Finance portfolio drops because the market is down, or because a particular stock you own performs poorly, SIPC will not reimburse you for those losses. This is the inherent risk of investing. The potential for growth comes with the potential for loss of principal. Let's illustrate this with an example. Imagine you have $10,000 in a savings account. If your bank fails, the FDIC would likely reimburse you your $10,000, assuming it's within limits. Now imagine you have $10,000 invested in an M1 Finance account, and the market takes a 20% downturn. Your portfolio's value would likely drop to $8,000. In this scenario, SIPC offers no protection because the loss is due to market fluctuations, not the failure of M1 Finance. Your $8,000 of securities are still held by the brokerage firm, and if M1 were to fail, SIPC would protect your access to those $8,000 in securities. Beyond market risk, let's consider other risks associated with an M1 Finance account. Systemic risk. While SIPC protects against the failure of the brokerage firm, there's always a broader, though less likely, systemic risk within the financial system. If the entire financial system were to collapse, the efficacy of even SIPC protection might be tested. This is a highly unlikely scenario, but it's a theoretical risk that applies broadly to investments. Liquidity risk. While M1 Finance strives for efficient trading, there can be some liquidity risk, particularly with less common or thinly traded securities. If you need to sell certain investments quickly, you might not always get your desired price, or there might be delays in finding buyers. For a cash account, your money is typically highly liquid and accessible. Custodial risk. When you invest with M1 Finance, your assets are held by a custodian. M1 Finance uses Apex Clearing Corporation as its custodian. While Apex Clearing is a well-established firm, there's always a theoretical risk associated with the custodian. However, SIPC protection is designed to cover situations involving custodian failure as well. Cybersecurity risk. Both cash accounts and M1 Finance accounts are susceptible to cybersecurity risks. If your login credentials are stolen, or if there's a data breach, unauthorized access to your funds or investments could occur. Banks and brokerage firms invest heavily in cybersecurity, but it's a constant battle. This risk is present in any online financial interaction. Inflation risk. For both, while cash accounts are directly exposed to inflation eroding purchasing power, M1 Finance accounts, if invested wisely, can potentially combat inflation. The goal of investing is to have your money grow at a rate that outpaces inflation. However, if your investments perform poorly or inflation is exceptionally high, you can still lose purchasing power in an M1 Finance account. With that said, thanks for watching, and until next time.